Today's presentation is about helping people borrowing in and into retirement and in respect of their children, whether it's helping their children or the children themselves. What we'll talk about today is the later life lending landscape, the demand, ever increasing demand for later life lending, where we come in, our winning criteria, our people making the difference, including the people behind the scenes helping this morning, some case studies, brokers and the industry agree with what we're doing, and you can chat to us. So, a bit of background on the landscape. There's an estimated £9 trillion worth of wealth in UK housing. 51% of UK households are expected to rely on housing wealth to support their spending needs in retirement. And that's certainly something we're seeing here at Suffolk. And potentially that could increase to £23 billion annually by 2040. People are living longer, some are having to work longer or wanting to work longer, and the state age, pension age is getting later. The average age of first-time buyers continues to rise also. More people are either entering retirement with a mortgage or taking a mortgage in retirement. The FCA has recently identified the later life market as a core area of focus for them in this year and beyond. And as an industry, we need to be looking at customer outcomes and solutions. There is no typical later life borrower. Some customers, and by the way, that's my West Country accent coming out there. You'll hear it a few times whenever I say borrower. So some customers are needing a mortgage. It could be an existing mortgage with the high street that's coming to the end or come to the end of its term. And quite often, your clients will be coming to you with only a very short period until that's happened or it's already happened. The repayment vehicle might have been downsizing, but your clients actually aren't ready to downsize. Perhaps they've been looking for the right property in the right area and simply haven't found it, or they've had a change of heart and they want to stay where they are. They might have had a significant life event, which means they've started over late in life and need to take a mortgage into retirement. That might be a relationship breakdown. It might be a relocation to a more expensive area. It could be any number of scenarios. We're seeing lots of this where your client's supporting a loved one with joint buyer sole proprietor, and first-time buyers perhaps starting over. It could be home improvements. Maybe they're extending the property so they can accommodate visiting family members. Maybe it's a renovation. Maybe it's a downstairs bedroom, downstairs bathroom. Could be any number of things that your client's looking to do to their home. And of course, it's not just residential. It could be buy to let in later life. It could be a holiday let with 60 days personal use, which could be ideal for your clients in older age whilst they get the income from the buy to let or the holiday let. Some customers are wanting a mortgage. They want to help their children. They want to help their grandchildren onto the property ladder. They want to gift money, or they need to gift money to their children or grandchildren to help them with their plans. Maybe it's buying their first house or buying a bigger house. And maybe they want to do it now rather than waiting for it to be part of an inheritance in the future. It could be to boost income in retirement, maybe repaying other debt, or perhaps buying a buy to let to increase income in retirement. And increasingly, we're seeing it as a viable consideration for estate and IHT planning as well. So that's something that's become more and more prevalent over the last couple of years. We're helping you with more solutions, more flexibility, and we believe better customer outcomes. So we have options available that are wide-reaching. Lifetime mortgages aren't your only option for borrowers in their 70s, 80s, or even 90s. And actually, a case study I've got coming up, it's later, even older than that. There has been a shift towards intergenerational lending, which inevitably involves older applicants, whether supporting young families or being supported themselves by the younger families, or simply dealing with their own finances and situation. Whether in or entering into retirement, we offer our standard products. So they're not RIOs, they're not lifetime mortgages. These are standard products, regardless of whether your client is, in this example, 31 or 81. And our pricing model is not dependent on age. Okay. And we do a maximum term of 40 years. So we have no maximum age, subject to criteria, and a maximum term of 40 years. We also do residential, buy-to-let, holiday-let, self-build, expats, purchases, and remortgages are all entertained for your older clients. How we do it? I've already mentioned we've got no maximum age, subject to criteria. We have multiple sources of incomes that can be accepted in retirement. So private and state pensions, investment and dividend income, rental income, and we use employed, non-manual and self-employed income to 75 and manually employed income to 70. Okay, we can also monetize a SIP or an investment portfolio. With a SIP, as long as your client is age 55 or older and so can draw on it, we will take 80% of the fund value and divide by the term to give your client notional income that can be used for affordability. Give you an example, if they've got £200,000 in a SIP, 80% of that is 160,000. We've worked out we need £10,000 extra income a year to make it work. We do a 16-year term. If actually we need £16,000 extra income to make it work each year, then we do a 10-year term. So actually we can morph the term to get to the level of income your client needs to make it work. Similarly, with an investment portfolio, as long as it's professionally managed and at least £100,000 held, we will take 75% of the value and divide by the term. We wouldn't divide by less than 10. What that means is if your client wants an 8-year term, we divide by 10. But if they want a 15-year term, we divide by 15. Okay, we're just being a little bit more cautious with that source of income. We can accept foreign incomes. There's 16 different currencies we can accept, and we can accept multiple currencies on the same case. Okay, so it might be, for example, there's pension income from the US and from the UK. So, and they're domiciled in this country, we would accept both. We can accept 4 applicants and 4 incomes on all our lending except self-build. That can make a huge difference to your clients and how much they can borrow. We don't do survivor dual affordability. Okay, it's a standard term mortgage, so therefore we're assessing affordability as it is now. If we know your client, for example, is retiring during the term of the mortgage, then we would work out affordability based on their retirement income, but we're assuming survivorship. We're not needing to assess it one were to pass away. Can the other afford it? There is no need to fund a pension if we're not going into retirement, because that could be big for your self-employed clients whose perhaps pension plan is to sell the business. So we don't need them to be funding a pension if we're not going past age 70 or 75. And all our mortgages allow 50% overpayments. Just to be clear, that is per product term, not per year. So if they borrow 100,000 on a 2-year fixed rate, they can pay £50,000 off over the 2 years. That can all be in year 1, of course. It doesn't have to be a set amount a year, but no more than 50%. Very, very popular feature. Okay, and particularly older borrowers like that feature. They like the flexibility it brings. Perhaps they have got an inheritance, or they might be selling a buy-to-let or taking a lump sum from pensions or investments. So a very popular feature. So interest only and part. We have no minimum income for interest only. Okay, so that's huge. As long as it's affordable, and linked to the next point, affordability is calculated on interest only where it is interest only, and part where it is part and part, but there is no minimum income as long as it's affordable. We do sell of mortgage property to 70% loan to value, needing £250,000 equity on day one. Okay, so 70% all on interest only as long as they've got the 250. Something that's becoming increasingly popular is we will do sell of second property to 70% loan to value as well, with no minimum equity. Now, a big point of difference is that other property can be mortgaged. Okay. So, most common example we'd see is your clients maybe got 2 or 3 buy-to-lets, all mortgaged. As long as the equity across those buy-to-lets totals more or at least what we're lending on their residential, we'll do interest only on the residential to 70% loan to value. We also will do part and part to 80% loan to value with the extra 10% on repayment, as long as they meet our interest only criteria. So it's the minimum equity in the background properties or 250 equity in the residential property. Joint borrower sole proprietor has been absolutely huge for us. Last year, it made up 10% of all the business we did. And actually, this year, we'd expect it to be we'd expect it to be maybe a little bit more. So we do up to 90% on joint borrower sole proprietor. And again, we'll accept 4 applicants and 4 incomes. So that might be 2 proprietors, 2 joint borrowers. Now, unusually, your joint borrower can either gift if they're not living in the property or can actually live in the property as long as they're not gifting. Okay. So that actually is quite a popular feature. We have no maximum age to 70% loan to value. Above 70% loan to value, we'll go to the oldest applicants age 90. Okay, couple of case studies for you. One illustrating the typical example of joint borrower sole proprietor, where a parent might be helping a child, in this case, a daughter, and also another example where a son helped a parent. So the first one, the lady was mid-50s, 55, relationship split, needed to remortgage and raise extra money to pay off her ex. She was earning good money, but not enough to support the increased borrowing. Dad said he'd help out very kindly. Dad was 83 at the point of the application. Okay. And we did a 19-year term. No max age, pension income used throughout. The reason we did a 19-year term is the daughter was 55 and we'd use her earned income to 75. Okay. On the second one, it's very recent case application now in. I had a phone call from a broker saying, Ian, you're good with older borrowers, aren't you? Hopefully you'll all agree that we are. And it was a retired teacher looking to borrow £160,000 on an unencumbered property. A bit of digging, we found that the money was to be used for an extension. Okay, affordability wasn't quite working. I asked what the extension was to be used for, and I was told that the borrower was actually going to be living in the extension. I said, okay, what's going to happen to our main house, our security? And her son and daughter-in-law were moving in. Now, I then asked if the son could perhaps be a joint borrower, which he actually has been, and he's gone on the mortgage, and the full amount of borrowing is affordable in the case proceeding. So as I say, there's two different scenarios, both using joint borrower, sole proprietor. Our people make a real difference. Flexibility. We manually underwrite, and we look to find a solution. And quite often, particularly in the current market, I might get an inquiry and the team might get an inquiry and it doesn't quite work, but we might have a plan B for you. So it's always worth giving us a call. You might think that something is a bit unusual, and we say it's perfectly normal. Actually, digressing slightly, I'll give you another case where that's happened. I was asked if we'd lend to a self-employed gentleman looking to buy his dream house very recently, and there's no way it was affordable. And I asked if a joint borrower was available, and he said, well, you won't take his brother who works in Sydney, Australia, will you? I said, yeah, actually, we would use an expat as a joint borrower, and that application's come in. So there's an example there of thinking outside the box. We'll always chat through scenarios. Anyone would think I've seen this presentation before because I've mentioned Plan B already. And it's easy to get a hold of us as BDMs, our support team. You won't be sat listening to music for ages. We answer, I think it's 90% of calls within a minute. So you will hear from us. We've also got live chats, and you've got access to underwriters as well if you want to talk to the nominated underwriter on your case. Okay, and Brokers, including yourselves, thank you, and the industry agree. We've won a number of awards, and we're very excited to last week win the Mortgage Strategy Award for Best Building Society for Intermediary Lending, up to £5 billion in lending. So we're very, very pleased to have won that award, and hopefully it's an indication of how brokers are viewing what we're doing for your clients. You can chat to us at any time. You can either, just waiting for the slide. Okay, you can either use the Suffolk from Intermediaries website and the Get in Touch option, which will link into your individual BDM and for your postcode, or into the team. There's a help desk there, as I've already touched on, with a phone number and an email or a website, and there is a live chat option as well. So thank you very much for listening. Has anyone got any questions at all? Okay, thank you for the questions. David, do we lend to just state pensions? In theory, yes. Although on one state pension of 12,000 typically, and our minimum loan is 75,000, that's probably not going to work. But if there was a couple both receiving state pensions, then and it's a small amount of borrowing, we may consider it. So it is worth giving us a call. Sean, we don't do day one remortgages. The only exception is on self-build, as long as the land registry has been updated. But no, normally we'd wait 6 months for before we'll do a remortgage. Okay, I've got a question about adverse. We're not an adverse lender. Okay, we will consider credit blips that have been settled because we manually underwrite. We don't credit score. So if you've got a client who's perhaps had an issue with I don't know, a mobile phone or parking or a utility settled, and the rest of the credit file is absolutely fine, it's worth talking to us. Okay, if they've had historical adverse that's been settled for at least a year, and in the last year they've been managing their finances with no pressure, again, it's worth talking to us. With anything like that, if it's live adverse, no thank you. If it's anything else, then do give us a ring. Always useful to see a credit file and know the loan to value as well. Okay, Elliot asked about, please could you go over which forms of income are acceptable? Yeah, absolutely. So we'd obviously use earned income 75 as well as any pension income they're already receiving. The only exception is manual employed income, which is 70. Okay, but we can use both incomes. In retirement, we'll use state pension, private pension, investment income, dividend income, property income. Okay, and in addition to that, we can use a SIP. Okay, as long as your client is 55 plus and can access it, and we use 80% of the pot value in the SIP and divide by the term. Okay, and similarly with an investment portfolio, which might be a large amount under management, it might be 120,000 in stocks and shares ISAs. As long as it's professionally managed, we'll take 75% of the value in the investment and divide by a term, and we won't divide by less than 10. Hopefully that covers that off, Elliot. Okay, Jan, 2 houses on 1 title deed for a brother and sister. We wouldn't do that. We'd want a title split on application before we'd consider that. Good questions in there, Nadeem. So the short answer is yes. So your client's got a SIP and a state pension. If we keep it to 70% loan to value, we could potentially do a term of 40 years. Yes, we would then divide 80% of the SIP pot value by 40. And yes, the no max age and max 40-year term does apply on interest only. Just a flag there, Nadeem, that we'd need if it's sell and downsize, we'd need 250 equity. So the 30% equity would need to be at least 250,000 unless they have background properties.
Ian, I've got Andy asking, is there a minimum term?
Okay, our minimum term is 6 years. Okay, so yeah, nice straightforward answer. I read short. We don't lend in Scotland and Northern Ireland. It's England and Wales. Jan, yes, CPD is available on this session, and we'll send certificates out. Yeah, that's absolutely right, Nadine. So as long as we're not exceeding 70% loan to value, there's no max age on JBSP. Above 70% loan to value, it's to age 90 of the oldest applicant. Hi, Elliot. Yes, absolutely. So with joint borrower sole proprietor, the joint borrower can live in the property as long as they're not gifting funds, okay? So as long as there's no funds going into the transaction, then absolutely the parent can live with the child. We're seeing more and more of that, and the other way around with the children living with the parent. So yes, they could. So age restricted properties, Jill? No, we don't. We don't lend on age restricted properties, I'm afraid. Jan, are you happy with an older client on the title deeds but not on the mortgage? So if they're owning the property, they would need to be on the title deeds. Maybe give us a bell just that we're a bit more detail around that, Jan, or ping us an email. Hi, Mark. Thanks for the question. Yeah, 250 minimum equity is at the start of the mortgage, okay, not at the end. So so in your example, we would need to do that on the repayment basis unless they had another suitable interest only repayment method. Hi, George. Thanks for the inquiry. That's a bit of complexity on there, so do feel free to email us and we'll give that some proper thought and get back to you. Okay, thank you. Thank you all for listening. Sorry for the technical problems at the start. Thank you so much for nice feedback. Just a reminder that if you want a copy of the presentation, please let us know and we're happy to send it to you. You can distribute it to colleagues as well as being a reminder to yourselves. We will add you to our mailing list as well, again, unless you ask us not to. And we look forward to helping more of your clients with your future inquiries. Thanks very much. I'll now end the call. And thanks, Rachel. We'll make sure you get a copy of the presentation. Bye all.